Well, folks, welcome back. It is 4:30 Eastern, and this is our final session, our sixth and final session for Options Forum 2023. If you have been with us all day, congratulations on your endurance. It's a lot of material to cover in a day. If you're just joining us for the first time, welcome. But in any event, thank you for being a part of this session here this afternoon. I'm Rick Swope. I'll be your host for the next hour, and this session is entitled Using Price Charts to Select Option Strikes. Just a couple of quick things. We've had questions throughout the day. Are these sessions recorded? The answer is absolutely yes. This session, as well as any that you may have missed or attended, all of the sessions today have been recorded, and they'll be available tomorrow if you visit etrade.com/events and you choose the On Demand tab. In addition to all of the events from Options Forum, of course, we have an extensive library of educational sessions there, and you can deep dive in just about any direction that you want. So take advantage of that as you have an opportunity. As we get started today with this final session, I just want to let you know that everything we talk about is for educational purposes only, and nothing should be construed as a buy or sell recommendation. Our goal for this last and final session, we're going to shift gears just a little bit. We have been looking specifically at option strategies throughout the day today, but in closing today, we're going to focus more on the setup of the option mechanics, if you will, and that is choosing strike prices. Rather than choosing strategy, it's okay, how do we decide what strike prices? You know, you've got to choose your strike prices, whether you're looking at calls, your puts, and your expirations. And so it's important that you have an approach to all of those. One way that you can choose your strike prices is by looking at statistical volatility. And that's good. I mean, that's an important thing to take a look at. But what the statistical volatility does not capture is the behavior of how that volatility is showing up. In other words, volatility tells you how much uncertainty there is based on past performance and what the expectation is. But on top of that, we have something available to us in trading that adds another dimension, and that is the price charts. The price charts also give us trend. It gives us direction. So this session here is going to take a look a little bit more at the trend and direction. And so what we want to do here is apply the principles of support and resistance in helping us select option strike prices. And so the way we're going to walk through this is our agenda. We're going to start off by defining support and resistance. We're going to talk about uptrends and downtrends. We're going to look at something we call role reversal. Then moving on to channels and patterns, moving averages, and finally a couple case studies before, as I expect we'll have time to show you where some of these tools are available on the Power E-Trade platform. So we've got a lot to cover here. We'll step through it quickly, but as always, if you've got any questions or comments, feel free to take advantage of the fact that you're joining us live here and use that Q&A button. And the rest of the team is watching, and we'll keep up with that as best as possible. All right? So what is support and resistance? When we look at a chart, we want to understand what is happening with the price behavior. And key levels that we want to try to identify are what we call support and resistance. And you could think of them as the floor and the ceiling. Resistance is any price level that you're able to identify where the selling pressure becomes stronger than the buying pressure, and we see that the prices reverse and start to fall. Now, what we're going to talk about as we move forward in this presentation are ways to identify that. But the point being is, if I look at a chart, oftentimes I can identify a level that has proven itself to be a level that the buyers are just having difficulty getting above. And then for the time that that is in effect, I would call that the resistance. And likewise, support would be a floor. So anytime that I see a price level where when the price drops down to that level, the sellers are not able to continue it any further. And the buyers then come back in and the price pivots and starts to move back up. That would be the floor. And so that would be support. Now, these levels will change over time. And so you always want to be aware of shifting support and resistance levels and how strong those levels are. But what's important here is that when I can identify these levels, that informs my decision about where I want to consider my strike prices. And we'll, as I said, we're going to do this a little bit more as we go along here. But this is the key basis of what we're talking about. Now, along with support and resistance, we're going to use terms like uptrend and downtrend. Now, this may seem like some pretty foundational stuff, but even as we get deeper into trading, it's good to come back to the basics. An uptrend has a technical definition. That's higher highs and higher lows. If I have higher highs and lower lows, for example, that's not an uptrend. What that is higher highs and lower lows is a divergence or what we call a fan. And that's treated differently. But if I can see higher highs and higher lows, so that I've got a series of lows that are increasing and a series of highs that are increasing, that technically is an uptrend. In an uptrend, I want to identify support primarily. All right, so if I have an uptrend, my primary level that I'm interested in is the support level. Conversely, if I'm in a downtrend, which is defined technically simply as lower highs and lower lows both, then the level that I'm interested in is a level that connects the key highs, and that would be my resistance. So on an uptrend support, I'm connecting the key lows. On a downtrend resistance, I'm connecting the key highs. Now, if I'm doing this with a line that I am drawing, I have to subjectively figure out where that line fits. In other words, as I'm looking at this example, I've got a touch point here. Do I use that touch point or not? And if I use that one, does this one fit? And what you're doing is you're kind of adjusting that line to capture as many of those highs as best as possible into what we refer to as best fit. You know, you're rarely going to get a perfect match of highs to a single line. What you're typically going to have is I'm going to draw a line, and part of those highs are going to be a little bit above, part of them are going to be a little bit below, but all in all, it is the line that best represents the slope of the highs. Now, that's if I'm drawing the line. Sometimes I may use a technical indicator. We're going to talk about a couple of these. I may use a technical indicator to help me identify them, and then it takes the subjectivity away. Because if for example, let's say that I'm using a moving average, which we'll get to later in the presentation, a moving average is a calculated line. If you and I are looking at the exact same chart, and we both apply say for example, a 50-day simple moving average to the chart, your simple day moving average is going to look exactly like mine because it's a calculated line based on the data. Whereas if you and I are drawing a line, as we see on here, your line's probably going to be just a slight bit different than mine, but that's okay. We're both going to get the general idea. Okay, so uptrend support, downtrend resistance. Those are the things that we're going to be looking for. Now, let's step through and talk about several tools or several characteristics of charts that will show up at various times that can also help us find key price levels that will help inform our choice of strike prices. And the first one is what we call role reversal. Now, a role reversal actually happens a lot in price charts, and it happens over various time frames. Let me define it first, and then we'll explain kind of what happens and why it happens. A role reversal is any time you have a support that then turns around and becomes resistance, or it may happen the other way. You may have a resistance that later becomes support. Now, in this particular example, we are looking at support becoming resistance. But as I said, it could go vice versa. And here's what happens. I'm looking at my chart, and I see that the price comes down and bounces up. And then a little bit later, it tests it again. So right here, I have support, and right here, I have support. But then afterwards, at some point, it breaks below. And later, when the price comes back up to reach that same level that had previously been support, we see that it tends to exhibit the characteristic of resistance. Boom, it hits the line, resistance. Boom, hits the line, resistance. Now, why does that happen? Well, it could be a number of reasons, but a lot of times what we see is that there are key price levels that traders will trade around, and in reaching those price levels, it may be a level where the sellers wait until it gets up to a certain price and then they become more aggressive sellers, or the buyers wait until it drops to a price and they become more aggressive buyers. And many times in charts, we will see this back and forth movement between support and resistance, and we call that the role reversal. So if I see, I didn't want to move past that. If I see that happening, let's say for example, I wanted to sell a call. Let's say that I own this stock. All right, so I am an owner of the stock, and now it's trading down here. And I decide that I want to sell a covered call. I want to sell a call option against the stock that I own. Now, let's look at three choices. Do I want to sell it down here? I'm going to call that choice number one. Would I want to sell that down there knowing what I know about the role reversal? The answer is probably not. Why? Because based on the role reversal, this level down here is a level that I would expect the stock to be trading at. And remember, with a covered call, typically you're doing that for income. You're not really eager to have your stock called away. What you'd ideally like to do is to hold on to your stock and sell a call and collecting income, and then after it expires or you decide to close it, sell it again, and do that for a number of times. But if I sell it down below the role reversal level, I would really expect my stock to get called away. So I don't want it down there, okay? How about right here at the role reversal level? Remember, we're trading down in this level, and I'm going to call this number 2. Do I want to sell it down there or at the level where the role reversal is? You know, I probably do want to sell it close to that, or maybe just slightly above that. Why? Well, because by selling it near that level, I'm going to, remember, the lower the strike price, the more money I collect. But I don't want to sell it so low that I'm almost guaranteeing that my stock gets called away. So I want that balance between selling a low strike price to collect more money, but still being able to hold on to my stock. So I probably am going to want to sell it maybe just a little bit above that resistance line. Well, how about if I sell it way up here at level number 3? Well, there's I'm looking at that and I'm saying there's probably not a good reason to put it that far away, because based on the role reversal, I would expect that the stock will fall when it gets up to this role reversal line. And while selling it up here at the third level is very unlikely for my stock to get called away, when I go that far out, I'm not really going to collect a lot of money. And so my income that I'm expecting from this is pretty low. But notice that my choice on whether I do 1, 2, or 3 is all informed by the fact that I've identified this role reversal level. So that's one way that I would use a technical condition like a role reversal. If I'm down below the role reversal and I'm looking for that to be resistance, then that resistance helps me decide what strike price I may want to consider. Let's look at another one, channels and patterns. Let's look at a couple scenarios with a couple of these. The first one is a channel. We were looking at this past week in charting markets, which we had on Monday, and we saw that outside of technology, which is pretty bullish over the last couple of weeks, that there are a number of areas that are settling into channels. And so, again, this is something that you're going to see fairly often in certain markets. And a channel is just any time that you can identify parallel lines within which the stock is trading. A lot of times we look at this as horizontal parallel lines, but it doesn't have to be. You can have an upsloping or a downsloping channel. But in this example, notice that we come up here to a resistance, support, resistance, almost support, resistance. It's just pretty straightforward channel. You can use channels a couple of different ways. Some traders will trade while the stock is inside the channel, with the expectation that both the support, which is the bottom line of the channel, and resistance, which is the top line of the channel, will continue constraining the stock's movement. Now, this is where you may look at something that's referred to as a delta neutral trade. You're expecting not that the stock's going up or that the stock's going down, but that the stock will pretty much stay sideways inside the channel. But it's the fact that you have identified that channel that leads you to consider something like a delta neutral trade, for example, something like an iron condor, perhaps. Or an alternative situation is once you've identified the channel, you wait until you get a channel breakout, which is what we see right here. And then when you get the channel breakout, then you start to consider an option strategy based on the breakout. Now, one of the sessions that we have available in our recorded library is a session on setting price targets. You'll want to look for that title, Setting Price Targets. And in that session, we go into a little bit more detail on what we call a measured move strategy. Measured move is the name of it. And with a channel, one of the ways that we look at setting price targets on a channel breakout is I look at the distance of the channel from the top to the bottom. So this distance right here. And when I get a breakout from the channel, my expectation is that the price will move about the same distance above, or in the direction of the breakout, in this case it's above, as the distance of the channel. And so if I say, let's say maybe that the distance from the bottom to the top is $10. Once it breaks out, I'm going to be looking for it to move about $10 up. And so that will help me decide what kind of strike prices I want. We say, well, how do you decide? Well, it depends on the strategy. If I'm maybe I'm looking at a bullish vertical spread, a bull call spread or a bull put spread, I would choose my strike prices based on my expectation that with a $10 wide channel on the breakout, it would move up about $10. Okay, so something to consider with channels. There's various ways that you can apply the channels, and but again, it's all dependent on the fact that you have identified the channel to begin with. Something else that you might see, and that is a triangle. Could be an ascending triangle, could be a descending triangle, which is the illustration that we have here. A descending triangle is if I have lower highs, but the lows are equal. Now, if I had lower highs and lower lows, it's not a descending triangle. That, if you recall, was our definition of a downtrend. But in this example, I don't have that. I do have lower highs. So you see that I'm touching here, almost touching here, but not quite. I overshot a little bit here, almost touching here, touching here, touching here. This is a good example of best fit. You're not going to be usually catching those highs exactly. But as you can see in this example, I think we could agree that that's a pretty decent fit for those highs. And then the lows, you'll notice that they don't really get higher or lower. Here we are. We've got lows that seem to be pretty much on a level playing field. Now, this is called a descending triangle, and this has a bias to the downside. What I mean by that is, while it's certainly not guaranteed, if I see a descending triangle, I would expect the breakout to the downside, and that's what I'm going to be looking for. Now, if that's the case, once I identify this, I could do a couple of things. It's somewhat like a channel. If I'm early enough in the process, in other words, if I've got enough room left here and I'm not down to the point where that convergence is just about at the intersection, then I may decide to trade between the support and the resistance. And that may, I may do something as simple as buying a call on support and then selling it when it gets to resistance. Or I may choose a spread where I don't expect the stock to be up here above the above the resistance. And I can choose a strike price then that takes that into account. The other thing that I may be looking at here is I may wait for it to have my breakout. So I mentioned just a moment ago that the bias on this is to the downside. And I may say, you know what? Yeah.
Don't give me a break. Sorry to interrupt.
No, that's fine.
So Rick's still on. You're still on the same slide. You're on slide 13, and that's by design. But you're using a lot of drawing tools, and I'm wondering if not everybody is seeing what you were drawing. I'm completely seeing what you're drawing, but others aren't. So there's an annotation feature that I believe everybody could see, but I've gotten a couple comments where people say, he's talking, but I'm still looking at slide 13. Yeah, but you're animating slide 13. So I'm not sure there, Rick. Just heads up to you on that one.
Thank you. Just tell me. You are correct. I am on slide 13, and I am drawing on slide 13. So you should be seeing the slide that is descending triangle. Thank you for that, because we definitely want to make sure that stays fresh in everybody's mind. And I am getting a couple comments that folks are saying seeing all the drawings. Okay, good. That's a good reminder that if at any time something doesn't look right in your what you're seeing on your screen, or if the audio starts to get a little gets a little hiccup in it, one of the best solutions is refresh your browser. That's kind of the catch-all.
Yeah, that is a catch-all fix most of the time. So when you're talking about descending triangles, a lot of questions are, what's the time frame? Is this 5 minutes? Are these weekly charts? And my comments like, it kind of doesn't matter. A triangle's a triangle, but would you hit that one?
Absolutely. Thank you for bringing that up. Yes. So typically, I'm going to be looking at a daily chart, And based on the strategies that I do, I'm going to be looking at something like a 6-month to 1 year chart. But the point is, you can apply price patterns are applicable really to any time frame, including intraday charts. Even though I'm using a candlestick chart, I'm really not paying a lot of attention to the candles right now. If I were paying more attention to the candles, then I would not be as inclined to use it for an intraday chart, because open and close don't have the same significance on an intraday. However, with a daily or even a weekly chart, price patterns, yeah, we can apply them to any time frame. Okay, excellent. So the last thing that I was going to mention on the descending triangle is it's possible just to put this on a watch list, and then if you get the breakdown, then you take a bearish position of some sort, because as I said, the descending triangle has that bias to it. Okay, we just advanced now to the slide that's entitled gaps. Gaps, we get gaps a lot. And when do we see them many times? We a lot of times see gaps around earnings. Gaps simply represent any substantial space from one period to the next. In this case, I would say from one day to the next. Now, I say substantial, and I'm going to have to define this a little bit more, because if I look closely at this chart that's on your screen right now, fact of the matter is there are gaps between just about every period from one to the next. But I think we could agree that most of them are not significant. This one is most certainly significant. It jumps out at you. And a lot of times there is a reason for it. As I said, we'll see this with earnings, for example. Now, the key to gaps is that it represents an emotional event in the market. Let me explain what I'm talking about. If I have a gap up, maybe somebody has a bearish position. Now, if you have a bearish position, where do you expect the stock to go, or where do you hope it's going? Down, right? That's why you have a bearish position. Let's say you have a bearish position, and then all of a sudden you wake up the next day and boom, that bearish position has just gotten very bullish. Are you making money or losing money? The answer is you're probably losing money, because it's going the opposite direction of what you thought the market was going to go. Hence, you had the bearish position. Now, if you still hold on to that position after it jumped, this is just market psychology now. Let me ask you a question. You had a bearish position because you thought the market was going down. You wake up the next morning, boom, it's jumped up and you are losing money. Here's the question. How closely are you paying attention to your position? Now, there's a reason I'm asking that question. How closely are you paying attention to that position? I would suggest that most of you are really paying attention now. Why? Because you got money at stake. You are losing money. You don't like to lose money. None of us like to lose money. And so we're going to pay very close attention to this. Now, as we're watching it, a little bit later, lo and behold, the stock starts coming down. Now you're losing less money probably. And now it's coming down a little bit more. Now, here's the curious thing of what happens in market psychology. If you find yourself in a position where back here you had the position and now the stock is starting to come down so that it's back to where it started to sting you, what do you think you're most likely going to do? Hold on to it longer and now look for a profit? Or are you going to close that position, and by closing that position just say, you know what, I just want to get out of this? Well, a lot of times people are just going to close that position. And when they do that at the beginning of the gap. And what that oftentimes results in is when you get down to the gap, it tends to turn around. And so gaps oftentimes reveal themselves to be reversal levels. All right? Now, if you understand that kind of behavior in the market with gaps, now you could put the gap to your advantage in deciding on trading strategies. If you see the gap and as you're watching it, it starts to come back down here, you may say, you know what? When it gets down to this level, which is the beginning of the gap, I'm going to take a bullish position. I'm going to buy a call option with a strike price maybe a little bit below this gap level so that I get a little bit higher delta. And now, as it starts to bounce, I have a relatively high delta option position that will allow me to take advantage of that bounce in much the same way as if I had purchased the stock, but without the full risk exposure of whatever the stock price is. I mean, that's one of the benefits. That's one of the reasons why we're all trading options, right? It's for that leverage benefit. But the point here again is I would not know that if I did not understand the nature of how gaps behave on occasion. All right. So again, this is all about recognizing what is showing up in the chart and choosing a strategy, whether I'm bullish, bearish, or neutral. And then once I've chosen that strategy, then using the support and resistance levels to help me choose the strike price. Let's talk about moving averages for a moment here. Moving averages help me identify support and resistance, but without the subjectivity of some of the things we've talked about so far. My being able to identify a channel is not necessarily, there's still subjectivity there. I have to say, you know what, I think that's a support level. I think that's a resistance level. They're parallel lines. Therefore, it's a channel. But if I were to put one chart in front of 100 people in the same room, not everybody would have the exact same interpretation, or even if they did find the channel, it wouldn't be the same channel. So now we're going to shift to looking at a technical indicator, which is a moving average. And since this is a calculated indicator, it's going to be the same for everybody. A moving average is a trend following indicator. That's the first thing to keep in mind. It's a trend following indicator, which means I have to have an uptrend or a downtrend. If I don't have an uptrend or a downtrend, then I can't really use a moving average. As you see here in this area where the stock appears to be just at first blush, it appears to be in an uptrend. At that point, notice that this green line is in fact looking like it's serving as support, what I expect it to do. And then when that first support level is broken, the red line then starts to become support. Now, the moving averages, there's in fact, just this week, I did an entire hour on moving averages, talking about some various types of moving averages, simple moving averages, exponential moving averages, various weighted or triangular moving averages. You got a lot of choices of moving averages. Let's start with simple. Let's keep it easy. As you get a little bit more experience with some of these technical indicators, then you can adjust the parameters and try different styles. But let's just start with simple moving averages. It's what I do most of the time on my charts. Is I have two moving averages. In fact, the moving averages that you see on this chart are the ones that I typically start with. The green line, this line up here, is the 50-day moving average. That's 50. The red line down here is the 200-day moving average. Now, we oftentimes will start with one of three, and I'll explain why. It's either 20, and or 50 and or 200. Here's why. This is not arbitrary. 20-day moving average, because that's approximately the number of trading days in a month. And so that tends to smooth out month-to-month volatility, okay? And there are things that happen on a monthly basis with stocks, and, you know, it's a good number to work with if you're just starting out. 50, it's approximately the number of trading days in a quarter. And yes, you can get a little bit more precise, but it's a good approximation. 200, if you're following the logic so far, you would be inclined to say, well, that means that 200 is approximately the number of trading days in a year. But at that point, the rounding error starts to get pretty substantial. And so I don't say that 200 is approximately the number of trading days in a year. What I rather say is 200 has become the de facto default for long-term moving average. And so pretty much everybody looks at the 200-day moving average. And it's one of those things where why do we use it? Because everybody uses it. And the fact is, since everybody uses it, there's a lot of trading activity that tends to occur around it. And so whether you like it or not, don't ignore it. So 20, 50, and 200 are some of the more common moving averages. Like I said, I like to start with 50 and 200. And as you see here, in the uptrend, the 50 has done a pretty good job for a period of time as support. Then when it breaks, I look at the 200 as secondary support. Now, on the right-hand side of the chart, notice that now the stock looks like it's just starting to go sideways. We don't really have a strong trend at this point. When that happens on your chart, you want to use something else besides moving averages. But just remember, moving averages are trend-following indicators. In an uptrend, they will tend to act as support. Take a look at another example. In a downtrend, they will tend to act as resistance. Notice right here, 50-day resistance. Boom, right there, right there, right there. And then it breaks. Where does the resistance go to next? 200. When the stock starts to go flat, as it does on the right third of the chart, which one do you use? Neither. When the stock goes flat, remember, we don't have a trend. Since moving averages require a trend, we go to something else. But in my experience and in the experience of a lot of traders, if you do have a sustained trend up or down, moving averages are really simple, handy indicators to take out the subjectivity of identifying support and resistance on the chart. So you use that to decide, do I want a bearish, bullish strategy? And if so, how do I choose my strike prices? Do I expect the stock to go above a certain level, which is resistance? If so, do I want to choose a strike price that's in that level or out of that level? All right, let's do a couple things here now. We've got about 20 minutes left. Let's do a couple things. First thing that I want to do is I want to give you a couple examples just to kind of clear your head, sharpen your thinking. Here's my chart, case study number 1. Here's my chart. What's different about this chart from the ones that I've shown you so far? Answer, I haven't drawn anything on it yet. So my question to you is, what types of where would you start to identify support and resistance? Where would you be bullish and bearish? Think about that for a second. What types of things would you be looking for in a chart like this? All right, so I want you to just look at it. And if this were a chart that you were looking at real time and you're trying to decide on a trade, what kinds of things would you identify on the chart? Just give you a second to think about that. And in a moment, what I'm going to do is I'm going to advance the slide and show you what I'm looking at on this chart. Okay? Here we go. I'll advance the slide. Here's what I see. I see that there is a period on this chart where I do have a pretty good uptrend. Look at this support level here. This is where I would probably draw support. Some of you may have drawn support more like at that level, and that's okay. It doesn't make you right, me wrong, or vice versa. It just means that we're using different levels here, and we have to accommodate our trades accordingly. And then after that uptrend, I see a double top. I see we get a top here, and it comes across, and it gets another top here. Now, when a double top occurs, at the middle here, that's a support level, but I'm looking for a breakout. Now, notice what happened after that, I should say a breakout to the downside. Notice what happened after that breakout. That was support. If we extend that over, you remember what we called this point right here? This is an example of a role reversal. And then at some point, it's entirely possible that you may not be able to pick out what's going on. There are times when you look at a chart and it's what I call indiscernible. You say, you know what? I don't see an uptrend. I don't see a downtrend. I don't really see a price pattern. If you ever get to a chart that looks like that, don't force it. If the pattern or the trend or whatever is not identifiable, if you don't feel confident in it, then move on. I tell people that if you go to etrade.com and look at the stock screener, there are 10,366 stocks in the population of U.S. traded stocks. That means that if the one you're looking at is not giving you something that's working for you, go to one of the other 10,365. And chances are you're eventually going to find something that's going to work for you. All right? So indiscernible is a valid conclusion when you're looking at charts. And I run into that a lot. There are times, if you join us on the weekly webcast, there are times when I'm doing the market analysis and I may look at one of the sectors and you'll hear me go silent for a couple of seconds and I'm just saying, you know what, I don't see anything right now. And that's possible, all right? So that's the first. Okay, let's do another one before we move over to finishing today's session on Power E-Trade. Okay, here's a blank chart. Case study number 2 is the title, just to make sure you're advancing slides. What do you see happening here? Give it a second. Give it some thought. If you were observing the behavior of this price chart, what jumps out at you? Give you about 5 more seconds, and then I'll advance the slide and tell you what I'm looking at. How about that? I see a stock that has had substantial volatility expansion. Back here, I went from a sideways move to a little bit of an uptrend. And then all of a sudden, right here, when the volume exploded, notice the difference from left to right. The candles on the left side are fairly small. The candles on the right side are, relatively speaking, are much longer. On the left side, the candles kind of just march forward without a lot of gapping. On the right side, there's a lot of space between the various candles. All right, so I have gone now from a low volatility uptrend to a very high volatility, whatever you want to call it, back and forth. Now, does that inform your decision on your strategy and your strike price? Well, it certainly should. Back over here on the left side, you may want to be an option buyer. Over here on the right side, you may want to be an option seller, collect more premiums. Or you may want to have something that profits off of volatility in direction either one way or the other. Okay, so both of those can give you ideas, but you have to recognize it from the charts. Where is it going and how is it getting there are the questions that we want to answer. All right. Now what I'm going to do is I'm going to share my screen with you because I want to show you, before we finish up here, where some of these things may be found. So yeah, get ready to show this here to you. In just a moment, you're going to see my Power E-Trade show up, and it looks like I've got a chart of Walmart up here. This is a 1 year, I think I've got this set at 1 year daily. Yes, I have it set at a 1 year daily. Again, just full disclosure, I've got Walmart up here just because it's something that I was using as an example earlier. This is not a buy or nothing should be construed as a buy or sell recommendation. I'm just very clear on that once again. So where can I see some of the things? Well, since we just finished talking about moving averages just a moment ago, let me show that one to you. Up here at the top of your chart, when I'm on Power E-Trade and I go up here to the top of my chart, you see I've got some menu choices, views, displays, studies, events, and so forth. My technical indicators are going to be under studies. So if I click on studies, it will bring you down this pull-down menu, and now this is my list of technical indicators. It's an alphabetized list, and there's a pretty substantial number of studies on here. I have actually made moving average a favorite study, and the way I do that is simply by going to whatever study I'm interested in, and let's say that I wanted to go to average true range. It's one of our volatility numbers here. Average true range, and I click on that star. Notice that now it has pulled average true range up here to the top because it is a favorite. If I decide that I don't want that as a favorite anymore, I click on the solid star and it removes it from my favorites and puts it back in the list. So moving average, I click on moving average, and here we go. It gives me a window that I can customize. So I could, if I want, I could put a 20-day moving average on here. What type? I mentioned a moment ago that I've got a choice of a handful of different choices. Start with simple unless and until you decide that you have a reason to look at something a little bit more complex. Let's make this one a, what color do I want to make it? Let's make this one, let's make it black because I know that's not a color that I don't have on there yet. And then done. So now I've got, I actually have 3 moving averages. How do I know which 3? Well, if I go up here in the left side of my chart and I have plots, and I see that I've got 3 moving averages turned on, and I can click on any one of them to get the information on it. But basically, it's the green is 50, the red is 200, and the black is 20. Maybe I don't, I'm looking at something a little bit more short term, and I don't want the 200-day moving average on there. I don't have to delete it and recreate it. I can simply turn it on and off with that toggle. And now I'll be left with just the 50 and the 20. Anytime that I want the 200 back up there, I can toggle it back on. But let's scroll back here in time and see if we can find a good period where there's a trend. All right, here it is. This is this uptrend here. And notice that as it comes down, we've got support, 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 and then the trend goes sideways, and there's a good example of how it's no longer a tool that I want to use. Let me turn off all of the movement. Yes?
I'll give you just a second to catch your breath. When you switch from slides, the presentation, to media player, doesn't always switch for people. So for those that are saying it's not showing, you got to switch to media player, and it will. And if you miss what Rick was showing, remember etrade.com/events. It'll all be available on demand, so you can always go back and kind of catch up there. Keep going, Rick. I saw a couple people saying, I can't see what he's talking about. Well, just got to switch to media player, and it'll pop right up.
Yeah, that old switch to media player or refresh, those are the ones that work. I'm going to turn off all the moving averages now. So I'm now stuck with what I was talking about before, as I got a chart that just doesn't have anything on it. If I want to start drawing my own lines, I'm going to come up here to the upper left corner of the chart, And you'll notice in the far upper left corner is an icon that if I hover over it, it says draw. So I'm going to click on that. I'm going to zoom back out a little bit so you get to see more of that. I'm going to click on that. And when I get that, I'm going to get a list of icons. Now, if I don't know exactly what these are, let me click here and get the names. So the left choice at the top will give me the names. Now it starts to make a little bit of sense. And I see that I've got a lot of different choices here. Let's just choose a line, first of all. So I'm going to come down here to a simple line. Now I'm going to come back to my chart. I'm going to zoom out so I get a little bit more view here. And I'm going to turn the magnet off there. And let's say that I want to go from that low to perhaps that low. All right? Notice now that I have drawn freehand what I think is the support level in this period of an uptrend. I've got a support touch here. I've got a touch here. I've got a touch here. I get 3, 4, 5 data points. Notice that if I choose that line, after that support was broken here on the right-hand side of the chart, it dropped below the line, came back up. What did it do? The line that was previously support has now become resistance. Man, this chart's just chock full of examples. This is a role reversal right here. What is this right here? What comes after the role reversal? A gap. All right? What happens when look at this. I didn't even plan this. This is just a thing of beauty right here. Let me get a horizontal line right here. Notice the stock comes up, and what happens when it reaches the top of the gap? It turned around. You guys are going to think that I pulled that out on purpose, but that's just, I'm such a geek when it comes to technical analysis. It's stuff that actually gets me excited when I see stuff working this wonderfully. But I guess that's why you're here too, right? Because if you are here at 5:30 and you've been with us all day, then I hate to tell you, but you're just like me. All right. So here's some lines. Some other lines that I want to point out, that maybe some things that we didn't talk about, but I want to point out where they are because it's important that you know some things that you may be familiar with. In the F's here, the Fibonacci retracement, that's the most popular one. The Fibonacci retracement is going to be in your drawing tool. And that one, if you're familiar with that, that one does also help you identify support and resistance levels after a significant move. Channels, let's do that. Let me see if I can find a channel and take everything off of here. And let's close that up, and let's see if I can find an area perhaps where there would be a channel that I can show you a nice way to draw a channel. Let's see here. I'm going to just scroll back a little bit. All right, I want to find a sideways channel more. All right, this might be one. I'm not going to spend a whole lot of time looking, so it might not be a perfect one, but let me grab a channel. I'll show you how to do that. So you grab the channel line, and then we come here and we pick our low. Oops, it's up too early. I'm here. Pick our low, bring it across to here, and then go up here to the high. So something like that. Okay? Like I said, it's not the cleanest channel, but it really is not necessary to spend the time looking for the perfect channel. It does what I wanted it to do, and that is illustrate how you would use the tool and where you would find it. So let me encourage you, if you've not done it, is to look at this drawing tool. There is actually quite a bit on here. We give you the capabilities of doing some pretty powerful drawings and annotations on your charts. But until you're aware that it's there, and until you've played with it a little bit, you're probably not taking full advantage of it. So if you're using Power E-Trade, or you start to use Power E-Trade, make it a point to spend a little bit of time familiarizing yourself with that icon in the upper left-hand corner of the chart, which is the drawing tool. All right, we are down to the last few minutes. I'm going to zoom back out. Actually, I'm just going to go ahead and stop my sharing here. I'm going to just, let's see, we got 5 minutes. I'll tell you what, I think Sean, Dave, Steve, everybody's been keeping up pretty good with the questions. I want to make sure that I've got time to give a wrap on today's event. This has been, of course, Option Forum 2023. We've had 6 back-to-back sessions today. Let me mention a couple of things. First of all, it's very important for us that you give us your comments in the survey. If you haven't done that yet today, please take a moment and fill that out. It takes just a couple of moments. It's not one of these, not one of these surveys that has 20 questions in and it's going to take you half an hour to fill it out. There's only a couple of them. Fill that out if you would. Make sure you bookmark the page, etrade.com/events. Everything that we have coming up, you can register at that page, etrade.com/events. I also want to remind you that tomorrow at 12 noon is the office hours. We have 1 hour set aside for any questions that may have arisen from today. So if you go to etrade.com/events and register for office hours tomorrow at noon Eastern, you can come back and you've got a lot of time to work on questions and get you some answers and have some discussion. All of the recorded sessions are also found at etrade.com/events. You simply look for the On Demand tab. You click on that, today's sessions will be there, as well as the rest of our recorded library. And last but not least, I've mentioned this a couple times throughout the day, but this is not the only time of the year you get to see us. We are on live every week and then some, but you can always count on catching us Mondays, Tuesdays, and Wednesdays at 11 o'clock Eastern every single week. Charting markets, Mondays, stocks on the move, Tuesdays, options playbook on Wednesdays. Besides the fact that you'll learn about technical analysis, screening strategies, option strategies, and so forth, it's really a great opportunity for you to learn how to use the trading platforms and see it in real action, not just as an education session. Well, with that, I am going to say thank you so much for being a part of this. For myself, Rick Swope, for my teammates, Brittany, Sean, Steve, Dave, all of us here at your investor education team at E-Trade from Morgan Stanley, we sure appreciate you being a part of what we offer here, and we look forward to seeing you on many more in the future. And with that, we'll bring Options Forum 2023 to a close. Folks, have a terrific rest of your day, and we'll talk to you real soon. Bye-bye now.